Good morning, everybody, and welcome to the Daily Energy Markets podcast. It is February the 16th. It is TGIF, as the saying goes. Thank God it's Friday. Brent crude oil trading this morning in Asia, essentially unchanged at $82.82, and with WTI about $5 back from that, which has kind of been a consistent look for some time now, the spread between Brent and WTI at around $5. Let's kick off this morning with David Fife, Chief Economist at Argus Media. David, we are starting to see some G7 economies, and notably this week, UK economy and Japan economy fall into technical recession definitions, i.e. two consecutive quarters with falling growth. Your thoughts on the consequence or the ramifications of that for the oil markets?
Yeah, well, good morning. I think you're absolutely right. I mean, the talk of recession is certainly not news if you're sitting in Europe. Activity levels have been pretty weak. Consumer confidence is down. Retail spending is pretty anemic. So it's all adding up to a picture that, we think leads to relatively weak demand. Of course, Europe, Japan are not the main centers of oil demand growth. We still expect pretty healthy growth coming from the Asia Pacific. But we actually think we're not a million miles away from where the IEA is in terms of demand growth this year. We have growth of about 1.4 million barrels per day, compared to about 2.4 million barrels per day of growth last year. And, we've got less sort of revenge mobility from China, which is one of the key drivers last year. And we've also got this softness in other parts of the OECD. Perhaps surprisingly, despite the elevated level of interest rates in the US seems to have dodged a bullet, or the recessionary bullet, if I can put it like that. And, our expectation is the US economy continues to chug along relatively healthily, with an assumption that interest rates start to be cut sometime from the middle of the year onwards.
Andy Lavin, senior partner at Econs. Andy, your thoughts just following on from that. I mean, as we see the dominoes fall, it's like, crying wolf last year, recession never came. Now it sort of seems to be limping into view. Is it relevant, irrelevant?
I think it is relevant, because I think the key when we came out of COVID was where the demand was going to come back. And I think the longer it takes for that demand to come back, in my view, what you're going to start to see is when demand comes back in the OECD, people are going to be looking at lower carbon intensive energy because they've had time to think about it. So I think the demand will not come back as quickly as historically we've seen. So it does have an impact because I think it does push down the long-term demand from, let's say, the developed world who've got the money to pay for renewables and green energy.
And does just to sort of take that one step further, the obviously, as David referenced, UK, Japan, even Germany, maybe not significant actors for the incremental demand growth for oil, but do these dominoes continue falling in a sense? I mean, is the US in those sites? I mean, it's weird. China's in a structural growth, has been 5, 3, 4%, whatever it is. In China terms, that feels like a recession. In the US, it's supposedly booming, but it seems everybody's economically miserable. Is that a recession in this new weird world that we live in, where we've got stratospheric equity markets, but yet everybody on the street seems to be not enjoying the economic outlook? I was wondering, do these dominoes keep falling?
So I think I'm not an economist, so what I'm going to say next may well be totally inaccurate, but it feels to me that what we're starting to see the US is a kind of a market in its own right. So it's relatively clean in terms of it's self-sufficient for its own energy. It could be. It's got enormous political challenges, which means the government does things for political reasons, not necessarily economic reasons. And therefore, arguably, you can put it in a box all by itself. And I think exactly as you said, if the government were to be behaving like many of the other developed worlds, it would be in a very different place. They aren't, and therefore, as a consequence, as David said, they essentially dodged a bullet. The rest of the world,
I think they paid off the entity shooting the bullet with endless trillions of deficit.
Yeah, that is another way of looking at it. Exactly.
It's if you don't pay the piper, you're going to get shot. If you turn off the printing presses or don't have one. Daniel Rahmat,
I think sorry, just to close
please.
that out, but to come back to what Omar keeps saying. It is not sustainable. It has to come home to roost. You cannot just keep printing money. At some point, it will face the edge of a cliff.
Yeah, well, it's like everything, right? If we're all willing to buy into the facade that the king has got clothes on, then it will have. I think the message is in the $50,000 plus Bitcoin price, which is telling you that, hey, there's no clothes on this thing.
Yep.
But Daniel Rahmat, Senior Energy Security Consultant in Iran. Thank you, Daniel. Always great to get your perspective of things. Let's start with Iranian oil exports today. There's some question that the U.S. have woken up this year with a tighter, deciding maybe they want to enforce some of the sanctions they have all over the planet, including maybe on Iran. Is there any change there? Is Iranian oil exports flowing? China loving it still?
Hi, Sean. Thank you for having me. Actually, there was some news, as you said, that Americans have decided to somehow tighten the sanctions on Iran. But we had no very significant sign that these are going to impact Iran's exports towards China. And there were some up and downs recently on the volumes of Iranian deliveries to China. And the flow was in some days even suspended because of, I think, issues with the war in Yemen, more importantly, in the Red Sea, because there was some disagreements between Iran and China regarding how to behave with the Houthis and how to trade with them. And also we heard that Chinese have threatened Iran to cut imports or exports to Iran. Every type of trade would be limited if Iran cannot control its proxies in the region. And since the time, based on some satellite data, we have seen that Iranian spy ships were transferred to China's military base in Djibouti, and then I think Iran stepped backward to reduce the attacks on the Red Sea, and we witnessed that the number of attacks on the Red Sea declined very significantly after that move. And recently, even Houthis targeted an Iranian cargo ship, actually a cargo ship bounded for Iran. So apparently, the sanctions are not very directly impacting the volume of trade between Iran and China. Maybe in the future, if they decide to do so, they have enough tools, of course. But I'm not sure at the moment if Americans are that much committed to push Iran in this very critical situation in the region. I don't believe that they want to put Iran at the corner. They just want to make a deal with this country. So at the moment, let's say I don't believe that the sanctions are impacting the bilateral oil and other trades between Iran and China. So as you know, the lion's share of Iranian oil goes to China. So in total, I don't believe the Iranian oil was very significantly impacted.
So, David, if we have all of the oil flow as we saw last year, the Russians getting everything market, the Iranians getting everything they can to market, there's a lot of supply coming from multiple different sources. What's the pole in this $82 tent keeping Brent above when we've got, we've just highlighted, 2 or 3 of G7 economies in recession, China from any sort of relative definition in a recession. Where's the oil price? Is there more geopolitical risk in this $82 oil price than we're thinking?
I mean, I actually think given the weakening of the global economy that we anticipate for this year, I would prefer to see the geopolitical risk element actually as providing something of a floor. I think it's giving the Saudis and other key core Gulf producers a bit of a hand in terms of propping up prices at or around $80 a barrel Brent. So at the moment, I think it's more a floor than a price premium. Of course, the price oscillates as attacks take place in the Red Sea, etc. But I mean, our view essentially is this year, absent OPEC plus supply cuts and Saudi discipline in terms of production restraint, the market looks rather long. So it's able to absorb some of the geopolitical risks that are out there. And our view this year is that the core Arab Gulf producers in OPEC Plus are going to have to work pretty hard to prevent the reemergence of a surplus in the market.
Andy, the other aspect of things, I'm just wondering your thoughts on since COP28 and even before, we've seen the oil majors, certainly the European ones. The Americans really had never made that big journey towards transition, but the European majors, your former employer BP, have all kind of backed away from that and rediscovered their appetite for being defined as hydrocarbon companies. Now we're having just announced yesterday, JP Morgan and State Street Bank dropping out of what was the Climate Action 100 investor group. Very significant sort of a collection of financial institutions that had made commitments towards climate policies, etc., climate sensitive investing and so on. I'm wondering your thoughts on the impact of this sort of back away from the transition, the climate sensitivity, and moving back towards hydrocarbons, what that means for the oil markets, or how the oil markets should be adapting or adopting that information.
Oh, goodness me, that we could spend hours talking about this. So I've always felt that the majors would struggle to adapt to the energy transition. And that's because they've got billions of dollars that are sunk into assets that are all hydrocarbon based. It's their experience, it's their knowledge, it's their capabilities. So how can you take an enormous company like the majors and pivot into a very different energy space? So it's always going to be a challenge. And I think even today, unless you are kind of a startup company looking and working in that space, it's not as an attractive investment as the historic hydrocarbons. And the world still needs hydrocarbons. So the majors are sitting there saying, well, how do we move? But actually, we still need to keep what we're doing. And they don't know. And that's my honest opinion, is they don't know what to do. And that's why if you were to be able to go out 30, 40 years, I think we'll find the energy space is very different. Now, to come
but
back,
we did have the Aramco decision recently, and the explanation just a few days ago that the reason they backed away from the extra 1 million barrels a day of capacity was due to the transition of, amongst other things, but ultimately that was one of the triggers.
Absolutely, right? And but you need to look at Aramco in the context of the whole of Saudi Arabia, and Saudi Arabia is investing in the future, whereas companies like BP and Shell are kind of like, oh well, what do we do? It's actually much more difficult for them to do that. So I think in the short term, what you're going to see is I do not believe that any of the major oil companies are going to back away from essentially taking investment decisions. There may be a kind of a bias towards things that they can talk about as being greener, like energy, like gas, like LNG, and less focused on exploring for oil. But that's all you're going to see. So in reality, there'll be a focus on gas. People will always be expanding their production in terms of their current activities in oil. So I don't think in the short term it has any negative impact at all. If anything, it just supports what David was saying, is that it's going to continue to have this this potential oversupply sitting in the background, because expanding existing assets is always cheaper and quicker than building and drilling new fields.
I wanted to get, Daniel, just a perspective from Iran. I mean, obviously from being in Iran, what the current regional geopolitical stresses look like from there. There's obviously from the Western narrative in the US in particular and others, that Iran backed this and Iran backed that, are to blame for everything. And tensions growing, particularly in Lebanon with the Iran-aligned Hezbollah movement and so forth. But from sitting in Iran, what does this regional stress look like? Is there concern? Should there be concern that this could still conflagrate into one big conflict with Iran or not? What's your thoughts at this point, 4 months into the onslaught of Gaza?
It's a sort of a complicated question, Sean, because we should have
you had said to me before that in Iran, amongst from the sort of general view, not necessarily the body politic, but that there was a certain view that this was not Iran's conflict, that this is not for Iran to get involved in. And I'm just wondering, from the perspective of, there's a certain view from outside that for the regime to maintain its credibility, it needs to continue to be an ambassador of defiance against the forces of the West in the region. But from the ground in Iran, there's less appetite for taking that position. I'm just wondering where that sits and what you can say about that.
Sure. Many people since during the last 4 decades were blaming the system, the establishment, for getting involved in the Arab issues in the Middle East, the Palestinians and Israelis. But this is a strategy, this is the approach that the Iranian establishment has decided. So regardless what the people generally think about it, of course there are many protesting against this behaviors. Maybe they think this is not appropriate for our national interests. Even in the body of the political system, some people disagree with more involvement in this crisis. But regardless what the opposition think or what the people in the street think, this is the decision that the government has decided to do. But we have signs that this conflict is touching or is actually slowly coming into our territories. Last week we had 2 huge explosions. This week, we had 2 huge explosions in the gas transmission pipelines in the country. 4 major pipelines were destroyed, and something 20% of the gas flow of the country was suspended. And as you know, in the winter, we have maximum output of 850 million cubic meters of natural gas in our gas refineries. And we have a deficit between 250 to 300 million cubic meters per day in the winter. So you see, we are deep in the deficit, and 20% of the gas transportation was suspended. So that's a big damage to our industries, petrochemical industries, power plants, cement factories, and steel factories were affected. And that increases at the end the prices of the products, and the ones who are going to sell in the domestic market are going to leave inflationary impacts on our economy, and the ones who are going to be exported will not be able to compete with foreign products. So we see the conflict is not only affecting our Iran's actually figure in the global community, and also increasing the risk of the country and the risk of the region, but also it's step by step coming into Iran. Last month we had actually an exchange of missiles with Pakistan on terrorist groups, and we see that the border between Iran and Pakistan was never safe, but it never reached the level that the 2 governments hit each other, the 2 militaries hit each other. In practice, they didn't hit the military of Pakistan, or neither the Pakistanis hit Iranian, but we had that the Iranians hit the territory of Pakistan, they did it to us.
And is
So
there a
you
sense
see-
that all of these things are connected, or they're all separate corridors?
They are apparently separate, but in fact, they show that the level of tensions in the region is increasing. So we are in a general, in the bird view, you can see that Iran is becoming the epicenter of the crisis, the epicenter of the tensions, while the decision of the government, the decision of Iranian regime is to step back and throw the conflict out, maybe to the borders of Lebanon, the borders of Yemen, elsewhere. But now it's coming in. So these types of risks would eventually push the Iranian system to rethink its strategy, probably, or to enter an all-out war or something like that to increase their level of crisis. But at the moment, I think that Iran's concern is to prevent Lebanon to fall into a war with Israel, because Hezbollah is an important asset for Iran. Iran is not going to risk that. It's not like Gaza, because Gaza technically and fundamentally was different with the Iranian ideological system, but Hezbollah is absolutely the same as the system is, and it's very important for Iran. So this domino-like war, the Gaza, Yemen, Iraqi proxies, and Lebanon, etc., blah blah blah, would at the end help Iran to stay in the safe side. But some of those proxies are very important for Iran. You see the reactions of the US on the proxies of Iran in Iraq was very limited, very, very limited. So Iran and also the Iraqi proxies decided not to respond, and accept the Americans' revenge in that scale, because of course some US militaries, some US soldiers were killed in Syria. So I think Iran hesitating entering an all-out war, or even escalating the crisis with the states, or even with Israel. But there is another question: whether, there is a scenario that Iran, if Iran is behind, if we assume Iran is behind the October 7 attacks on the Israeli territory, maybe that was a sort of assumption, that was a sort of conclusion that Iranian intelligence has reached, that Israelis are definitely going to attack our nuclear facilities. So they did a small attack through Gaza to keep them into a never-ending conflict in the region, and then they will never be able to hit back Iran or start raiding Iranian nuclear facilities. If we accept this, Iran should keep a level of crisis with Israel. The level of conflict with Israel should never go lower than a certain level, and should never increase than a certain level. That would end up in a war with Iran. You see, Iran wants to keep the conflict in a certain level, to keep Israeli military busy with the surroundings, so they cannot plan or implement an attack on Iranian territory. This is a scenario.
Yes. Thank you for that. I was worth obviously giving a few extra minutes for that insight, because it's always good to get fresh perspective from the ground in all of the countries in which we want to have some views on. Let's go to the survey question and get a sense there. As we started our conversation this morning, will oil prices fall as we see some G7 countries dip into technical recession? i.e., is this a bearish domino trend? Will it be a trigger to break away from this $80 barnacle where the Brent market seems to be stuck happily on, one would add, and get a view from the room? David, oil prices, Brent, with the year that we're in it now, a month and a half, the average price has been, not far off where it is now, maybe $80, let's say, on Brent. That's a pretty happy sweet spot for producers, I would say. Everybody wants more, but ultimately they take that as an annual average for the year. I'm wondering, where does that intersect, in your opinion, the so-called expectation of monetary policy easing? It sort of keeps drifting further away into the distance. I'm wondering, does $80 Brent average for 2024 keep rates cutting at bay, or because it is inflationary in itself? Or your thoughts on the intersection between those two things?
I think essentially $80, as other people have said, is probably something of a Goldilocks price. I think the Saudis and their Gulf neighbors and others within the OPEC Plus firmament are probably quite happy with that. And I don't think it's so high that it's, by and of itself inflationary. I would be a lot more concerned, I think, from an inflationary standpoint about the potential for sustained disruptions on flows, shipping flows through the Red Sea. I think for Europe, that potentially adds, 0.3, 0.4 percentage points to inflation this year. So that is an issue. But $80 crude itself, I suspect is not going to be sufficient to have a major influence on monetary policy going forward. We would expect that around mid-year we start to see interest rate cuts by the key central banks, but it's going to be a very slow process, and we suspect that policy is going to remain relatively restrictive over the next 12 to 18 months. That is to say, policy rates above their sort of pre-financial crisis average of sort of 3.5%, 3.8%.
Andy, last word to you. I wanted to get your thoughts on the sort of, how you would, if you were still in the markets on the front end of trading, how you would be holding at this point. Is this a time still to be long?
I think it depends upon your time horizon. I would say for the rest of, even though it's quite a long time, for the rest of this year, as David commented, $80 is kind of like a bit of a happy place for everybody. It's not that expensive, but it's not cheap. So OPEC would like it to be higher, but I don't think they are biased to push it higher. But I think if it started to drop off, I think then they would start to get concerned. They've got a lot of investment to make in their countries, especially in Saudi. So $80 kind of works for everybody. So I think where we are today is probably, there'll be noise. It'll go up and down. It'll probably trade in quite a narrow channel for the rest of the year, is my view.
Yeah, it's hard to see what would be the trigger to shift it, and I'm sure something will come along, because that's been the nature of the black swan years that we've lived since the halcyon days of 2019. It seems like another universe. We'll have to wrap it up there. Wrapping it as we started. The view of this room is that the G7 recessions won't have much of an impact of reducing oil prices. We'll put that out to the wider voters on social media. Brent is trading this morning at, as we said, going into our meeting at around 82.80, and it sort of is stuck there without too much change, exactly 82.80. We'll see where it goes as it closes out the week. It's sort of closing out the week where it started. So perhaps that's an interesting development, in the sense that the last few weeks have been sort of up and down 5% each week. And now we're seeing something of a stable week finish where we started. And perhaps that could be a platform to move higher. Some banks are calling that as a track. We're seeing the likes of Standard Chartered and others still saying that Brent needs to get to 90 based on the fundamentals. JP Morgan seem to be echoing that as well. So we'll see if this is a slow grind up, as mentioned on the podcast this morning, that the geopolitics is a floor for this market, and perhaps it'll continue to be so. It's 11 o'clock in the UAE. Thank you so much, everybody, for your time today. Obviously, Andy here in Dubai, David in London, and Daniel in Tehran. Really appreciate your insights. Have a great weekend. All the best.
Thank you. Have a great weekend.
Bye now.
Bye-bye.
All the best.
Thank you.